The Federal Reserve now is expected to hike interest rates as soon as tomorrow.
But by how much? And what will that mean for our wallets?
Yeah, some good questions there. Allison Gormly has some answers tonight in What's the Deal?
8 times a year, the Federal Reserve, which is the nation's central bank, meets up to take the economy's temperature and act accordingly.
Inflation has been accelerating, and this has added some urgency to the Federal Reserve getting started with this process of raising the cost of money to pump the brakes on the economy.
Greg McBride with Bankrate said when the pandemic started, rates were dropped to near zero levels to make sure people kept spending. And spending we did. So now that needs to be unwound a bit, one baby step at a time.
And they're going to start bumping those up, beginning with a quarter-point increment this week.
So if, but likely when, this rate hike happens, how will it affect your wallet? Existing fixed loans like your mortgage or car payment, those won't be affected. But debt with a variable rate, or a rate that can change, will be.
If you have variable rate debt, such as a credit card, look at one of those 0% or other low rate balance transfer offers now. That will insulate you from the rate hikes we expect.
Not only do you want to think about credit card debt, but a home equity line of credit too.
See if your lender will allow you to fix the interest rate on your outstanding balance. That's another great way to insulate yourself from the effect of rising interest rates.
If you don't have variable debt, look at where your savings is parked. McBride said traditional banks, well, they're not in a rush to pass on the higher rates to your savings. However, online banks, they will. I used the Bankrate tool to look at online savings accounts rates, and they ranged from 0.5% to 0.7%. A brick and mortar shop, you're looking at 0.01%. So don't leave money on the table.